Hello, this is Samantha Shares. This episode covers the interagency statement on elder financial exploitation. The following is an audio version of that statement. This podcast is educational and is not legal advice. We are sponsored by Credit Union Exam Solutions Incorporated, whose team has over 240 years of National Credit Union Administration experience. We assist our clients with NCUA so they save time and money. If you are worried about a recent, upcoming, or in process NCUA examination, reach out to learn how they can assist at marktrikel.com. Also, check out our other podcast called With Flying Colors, where we provide tips on how to achieve success with NCUA. And now the statement. Interagency Statement on Elder Financial Exploitation. The Board of Governors of the Federal Reserve System, FRB, Consumer Financial Protection Bureau, CFPB, Federal Deposit Insurance Corporation, FDIC, Financial Crimes Enforcement Network, FinCEN, National Credit Union Administration, NCUA, Office of the Comptroller of the Currency, OCC, and state financial regulators collectively. The agencies are issuing this statement to provide institutions supervised by the agencies, supervised institutions examples of risk management and other practices that can be effective in identifying, preventing, and responding to elder financial exploitation. This statement does not replace previous guidance on this subject issued by any of the agencies, does not interpret or establish a compliance standard, and does not impose new regulatory requirements or establish new supervisory expectations. It is intended to raise awareness and provide strategies to supervised institutions for combating elder financial exploitation, consistent with applicable legal requirements. Background. Elder financial exploitation is the illegal use of an older adult's funds or other resources for the benefit of an unauthorized recipient. Elder financial exploitation can deprive older adults of their life savings in whole or in part, devastate their financial security, and cause other harm. A recent study estimates annual losses from us older adults as a result of elder financial exploitation at $28.3 billion. The U.S. Department of the Treasury's 2024 National Money Laundering Risk Assessment described elder financial exploitation as a growing money laundering threat, which has been linked to more than $3 billion in reported financial losses annually. Furthermore, a FinCEN review of Bank Secrecy Act (BS) a report data found that financial institutions filed 155,415 reports related to elder financial exploitation between June 15, 2022, and June 15, 2023, associated with more than $27 billion in reported suspicious activity, which may include both actual and attempted transactions. In addition to financial losses, elder financial exploitation can also result in increased reputational, operational, compliance, and other risks for supervised institutions. Federal and state government agencies have raised awareness of elder financial exploitation and worked to educate supervised institutions and consumers about prevention and response strategies. In this statement, the agencies provide examples of risk management and other practices that supervised institutions could consider adopting. Additionally, Appendix A to this statement provides a list of resources issued by federal and state agencies on this topic. Section 1. Governance and Oversight. A number of laws and regulations related to consumer protection and safety and soundness may be applicable to instances of elder financial exploitation. Consistent with such laws and regulations, a supervised institution's oversight strategies may include policies and practices to better protect account holders and the supervised institution from the impacts of elder financial exploitation. Supervised institutions may consider enhancing or creating risk-based policies, internal controls, employee codes of conduct, ongoing transaction monitoring practices, and complaint processes to identify, measure, control, and mitigate elder financial exploitation, provided such policies do not result in age discrimination that is impermissible under the Equal Credit Opportunity Act (ECOA). Effective actions aimed at guarding against elder financial exploitation include open lines of communication among supervised institutions, departments responsible for researching and responding to unusual account activity, for example, across functions such as BSA compliance, fraud prevention, and consumer protection, including fair lending. Compliance with applicable privacy or other legal requirements is necessary to ensure that the information of account holders remains confidential and secure. Section 2. Employee Training. Supervised institutions may find it beneficial to provide clear, comprehensive, and recurring training for their employees on recognizing and responding to elder financial exploitation. Well-trained employees can increase a supervised institution's ability to detect and report elder financial exploitation. Employee training may include identifying red flags for different types of financial exploitation, providing proactive approaches to detecting and preventing elder financial exploitation, and detailing actions for employees to take when they have concerns. Customer-facing employees may be trained to identify transactional and behavioral red flags when conducting transactions for older adults, including via powers of attorney or other agents. Employees may also benefit from detailed escalation processes and written procedures that promote timely action for events they are most likely to encounter in their roles. Federal law provides that a financial institution and certain employees are not liable in any civil or administrative proceeding for disclosing suspected elder financial exploitation to covered agencies if the financial institution has timely trained its employees on identifying elder financial exploitation. Section 3. Using transaction holds and disbursement delays. Supervised institutions have used transaction holds and disbursement delays to prevent consumer losses and respond to various situations that may involve elder financial exploitation. These practices should be used appropriately and in compliance with applicable laws and regulations. Some state laws permit supervised institutions to temporarily hold a transaction or delay a disbursement of funds when they suspect any type of financial exploitation, including elder fraud. 14. These statutes generally provide timelines for transaction holds, and some provide immunity for institutions and employees who meet specific requirements. Supervised institutions may benefit from establishing and implementing policies and procedures based on applicable laws and regulations. It may be helpful for supervised institutions to consider various factors, such as the account holder's explanation of the purpose of the transaction, the requirements to provide disclosures, and the prohibitions against unfair, deceptive, or abusive acts or practices. Supervised institutions may also consider procedures for older adult account holders and their designated representatives to establish the legitimacy of a potentially suspicious transaction. Section 4. Using trusted contacts. Supervised institutions may establish policies and procedures that enable account holders to designate one or more trusted contacts that employees can contact when elder financial exploitation is suspected. For example, an account holder might identify one or more family members, attorneys, accountants, or other trusted individuals and authorize the supervised institution to contact them if the supervised institution cannot reach the account holder or suspects that the account holder may be at risk of financial exploitation. Unless separately authorized by the account holder, a third-party trusted contact typically would not have authority to view account information or execute transactions. If a supervised institution establishes a trusted contact designation process for account holders, it may be beneficial to develop clear and effective procedures for when and how to disclose to the account holder and trusted contact that one or more transactions have indicated that elder financial exploitation may be occurring. Any disclosures to account holders or trusted contacts must comply with applicable privacy laws and legal prohibitions, including the confidential nature of SARs. Section 5. Filing SARs involving suspected elder financial exploitation. In certain circumstances, financial institutions are required under FinCEN's, the NQS, and the federal banking agency's laws and regulations to file SARs related to suspicious activity and suspected violations of law or regulation, which may include fraud and elder financial exploitation. Additionally, supervised institutions can voluntarily file SARs for suspicious activities related to elder financial exploitation that do not meet the requirements for mandatory filing, such as those involving dollar amounts lower than the regulatory threshold. Supervised institutions can consider how to detect and identify possible red flag indicators of suspected elder financial exploitation, such as unusual behavior of an older adult or their caregiver, or an unexpected, large wire transfer out of an account from which the account holder has no history of similar activity. FinCEN's 2022 advisory on elder financial exploitation provides examples of financial and behavioral red flags. Supervised institutions can include any observed red flags of financial exploitation in the narrative section of the SAR to describe the reasons why the activity is suspicious. FinCEN's 2022 advisory also requests that financial institutions mark the Elder Financial Exploitation checkbox SAR Field 38D and include FFIN 2022-02 in SAR Field 2 Filing Institution Note to FinCEN and in the narrative to indicate when elder financial exploitation is suspected. 23. This approach provides potentially useful information to law enforcement and supports accurate elder financial exploitation SAR data analysis and trend tracking. Supervised institutions are reminded of the confidential nature of SARs and the prohibition on disclosing a SAR and any information that would reveal the existence of a SAR, except in authorized circumstances. No financial institution and no current or former director, officer, employee, or agent of a financial institution that reports a suspicious transaction may notify any person involved in the transaction that the transaction has been reported or otherwise reveal any information that would reveal that the transaction has been reported. Section 6. Reporting to law enforcement, adult protective services apps, and/or other entities is appropriate. Timely reporting of elder financial exploitation increases the likelihood of successful recovery of funds. In 2013, the CFPB, the Commodity Futures Trading Commission CFTC, FDIC, FRB, Federal Trade Commission FTC, NCUA, OCC, and Securities and Exchange Commission SEC issued joint guidance to confirm that the privacy provisions of the Gramm-Leach-Bliley Act generally do not prevent financial institutions from reporting elder financial exploitation to appropriate local, state, or federal agencies. Some state laws require certain supervised institutions to report suspected elder financial exploitation to apps, local law enforcement, and/or regulatory authorities. In states without mandatory reporting, there may be avenues for supervised institutions to voluntarily report suspected elder financial exploitation to relevant state or local authorities. Voluntarily notifying law enforcement directly of suspected elder financial exploitation and the underlying facts may expedite and assist law enforcement investigation and prosecution. In addition to filing various reports, supervised institutions can consider establishing procedures for referring individuals who may be victims of elder financial exploitation to the U.S. Department of Justice DOJ's National Elder Fraud Hotline 833-372-8311 for assistance with reporting to the appropriate government agencies. Supervised institutions may also consider informing older adults about the options for reporting elder financial exploitation to local law enforcement. FTC, the FBI's Internet Crime Complaint Center, IC3, the U.S. Postal Inspection Service USPIS, the Social Security Administration SSA, or other federal, state, or local agencies. 31. Some agencies or programs may be able to help victims recover stolen funds. For example, the IC3 Recovery Asset Team is a domestic program designed to streamline communication between financial institutions and assist FBI field offices with the freezing of funds for those who made transfers to fraudulent accounts under false pretenses. Another example is FinCEN's International Rapid Response Program that helps victims and their financial institutions recover funds stolen as the result of certain cyber-enabled financial crime schemes, including business email compromise. Section 7. Providing financial records to appropriate authorities. In addition to the reporting procedures discussed above, in some instances and consistent with applicable law, supervised institutions may expedite documentation requests for apps, law enforcement, or other investigatory agencies for active elder financial exploitation cases. For information on providing supporting documentation for financial records that are associated with a SAR filing, please refer to FinCEN's facts. Supporting documentation refers to all documents or records that assisted a supervised institution in making the determination that certain activity required a SAR filing. Section 8. Engaging with elder fraud prevention and response networks. Supervised institutions may also help protect older adults from financial exploitation by engaging with elder fraud prevention and response networks that include professionals from various agencies and organizations. These networks are often cross-disciplinary, collaborative efforts to protect older adults from financial exploitation. These networks can help improve coordination among supervised institutions, law enforcement, a PS, local aging service providers, and other key partners. Networks can also help supervised institutions engage in professional cross-training, multidisciplinary case review and coordination, and community education efforts related to elder financial exploitation. Section 9. Consumer outreach and awareness. When consumers are informed about specific types of scams and understand perpetrators' tactics, they are more likely to recognize a scam and are less likely to engage with a perpetrator or lose money. Supervised institutions can support their account holders by providing timely information about trending scams and ways to avoid them. Many federal, state, and local government agencies, as well as nonprofit organizations, trade associations, and other groups, provide free educational resources for consumers and caregivers about preventing elder financial exploitation. Supervised institutions are encouraged to share free resources provided by government agencies with their account holders or as part of community outreach and awareness efforts. This concludes the statement. If your credit union could use assistance with your exam, reach out to Mark Treichel on LinkedIn or at marktreichel.com. This is Samantha Shares, and we thank you for listening.